Welcome and thanks for joining the Union Budget 21. I have an illustrious panel with me. I am Vikas Vasal, National Managing Partner Tax for Grant Thornton, Bharat. I have with me industry representative Gopal Mahadevan, who is the Chairman CII-SR Economic Affairs, Taxation and Corporate Governance Committee, and also the Director and CFO of Ashok Leyland. Gopal, great to have you with us.
Thank you.
We will love to have your industry view. Let me introduce the other panelists first. We also have with us Dr. Gst Bhattacharya, an eminent voice on digital economy and the President, Center for Digital Economy Policy Research, and also the founder and CEO of Bharat Zap POS. Great to have you, Gst, with us. I also have two colleagues, Riyaz Singhna, who is a chartered accountant focusing on direct taxes, and Krishan Arora, who focuses on indirect taxes. So if I have to sum up the panel discussion in just one sentence about the budget, I think that will be a big, bold budget. And why I use the words big, bold is for the simple reason that it was announced in the backdrop of pandemic and huge fiscal deficit. The budget received a thumbs up from the stock market, 2,000 basis points plus. And I think from the industry perspective, it was a big sigh of relief. No increase in taxes. Probably everybody wanted it, but everybody was afraid something will come in. There was talk in the media about COVID cess or solidarity cess coming in, and we were talking in hushed tones. Maybe something will come up either on the corporate tax side or high net worth individual side, or maybe on the capital gains side, because the stock market is all-time high. Nothing happened on that, but there is a lot of things in the fine print which we'll cover. So I think let me straight away come to you, Gopal. What's your perspective as an industry representative? How do you see it?
I think, thank you very much, Vikas. I would say there are three things that went up today. One was, as you mentioned, the stock markets went up by nearly 5%. The second thing that went up was the bond yields because of the increased borrowings that are going to happen. And the third thing, which was the big bold move that you talked about, is the fiscal deficit target for next year, which is going to be at 9.5%. I think I like the last thing the best in terms of the government was kind of stating very clearly what their plan is when they've actually raised the fiscal deficit. Of course, the economists would say that this is breaching normal norms, etc. But I think in that way, the clarity that has come out from the government policy is good. Now, what I would say from the other side is one challenge that they do have, and I'm sure we're going to discuss this, and I'm not going to take too much time now, is that the 1,75,000 crores of disinvestment target that they've put in, the fiscal deficit is also going to, at some point in time, also going to hinge on that. And that's going to be super crucial for the government to execute. Overall, I think, as you said, the fear that there'll be much larger taxes was kind of abated, and people did, view a sigh of relief that that's not happened. And very clearly, I think this budget again has put an increased focus. What I would say finally is not incremental, be it on infrastructure, be it on education, be it on the financial services, some amount reasonably on bank capitalization, recapitalization, which of course, again, is not sufficient for the level of depth that may be required. But I think they have tried to manage this at the back of a very severe COVID. And I think both on the economic front and on the non-economic front, which is on the management of the COVID, I think it's good to start from where we are today. That's what I would say at the moment.
So Gopal, we have seen the government has actually literally opened up the purse strings in terms of the investment and capital expenditure. And I think the economic survey mentioned that government is doing its bit. Now private sector should come forward.
That's right.
Do you think there is enough in the budget to excite you and your other colleagues in the industry to make bold, big investments in the economy now?
I believe so. What will not happen, I think, and it should not also, even in good times, is to have big bang investments like this. I think after 2008, if you notice, because the investment that have been happening in the country have always been on a step ladder basis.
Right.
And everybody believes at this moment that we have bottomed out. We have tackled the COVID situation well. Demand is going up. Economies, I mean, the various sectors are opening up. We have also seen in my sector as well that the demand for vehicles is going. And these are higher tonnage vehicles, and similarly light commercial vehicles, which are for the final point of delivery, to the customer or to the shop or to the store. They are also growing quite significantly. So I believe that people would budget for a phase of growth. Let me put it that way. Instead of saying exciting for CapEx, all of us are in industry budgeting, preparing ourselves for a phase of growth over the next 3 to 5 years. And so we are planning for incremental investments to happen so that we have capacity to match the demand when it comes.
Great to hear that incremental investments are likely to happen. Industry view is positive. Jajit, on fiscal deficit, I think it's on the expected norms. But what was not expected is that the government will come out and make a bold policy announcement that, yes, we admit there is a huge fiscal deficit this year. We are likely to continue with the fiscal deficit next year, and will focus on consumption and investment both. And we will fund it not by raising the taxes, but through asset monetization as well as by borrowing. So what's your take on that, Jajit?
So because in fact, even yesterday, I had gone and recorded one of the TV channels saying that the fiscal deficit will actually be 8 to 9%. And it was unbelievable to some of the fellow panelists. But it's very clear once you look at the background. The background is in the previous financial year, 1920, growth had already gone down to 4%. So it is not a COVID issue. The growth had already started going down significantly to 4% in 1920. The fiscal deficit target was already breached. From 3.2%, we went up to 3.8% in 1920. In this financial year, 2021, which we are closing, the budgeted receipts was 22 lakh crore, with around 2 lakh crore or 1 lakh crore approximately that was expected to come from disinvestments. But the disinvestments did not happen for obvious reasons. The market was down. It would not have been proper the public sector assets at a low valuation, and therefore very little to no disinvestments happened. Against that budgeted receipts, the budgeted expenditure was 30 lakh crore, and on top of it, there was a fiscal stimulus of 20 lakh crore, 21 lakh crore in fact. And in addition, there was a sudden pressure for massive defense expenditure given the border challenges. Mm-hmm. So clearly, nominally, there was a hole of at least 30 lakh crore. The 8 to 9% that I was predicting, or 9.5% that the finance minister declared, had to happen. If there was anything else, that would be black magic. I mean, the deficit had to get significantly financed through the deficit financing. Now, on top of it, what the budget very neatly does is it calibrates a fiscal deficit target at 6.8% in the coming financial year, 21-22, with a gross expenditure of 34.83 lakhs, which is still larger than last year's expenditure. And overall, it says that there will be a glide path to 4.5% for fiscal deficit by the time 2026 comes, which means in the next couple of years also, we'll see significant deficit financing of the budget. And this is necessary. And this is something that I've been cheerleading because funded. And it may be, as Gopal mentioned, may not be something very palatable to most other economists. But what is necessary to be done to revive the patient right now is important, rather than looking at the future implications where the patient may not exist. So many of the businesses may go belly under, many of the jobs will disappear. And hence, it is important that we quickly fund and bring in the growth that is needed by marshalling all the fiscal tools that are there. In addition, I hope the monetary tools will also be used as we move forward. And the real sector interventions are also done, which has also been laid out in this budget, and possibly later in this discussion will come down to some of the real sector interventions that this budget talks about.
Sure. Interesting, Jajit, that in the economic survey also, it was mentioned that India should take a bold measure in terms vis-a-vis the global rating agencies. I think for the first time we heard that probably the message is coming loud and clear that India's sovereign ratings are not in sync with the capital or the GDP that we are creating, which is the 5th largest economy. And I think in the budget also that that message has been reiterated, that even with 6% plus deficit next year, I think we are still going ahead with the expenditure plans. What's your take between the economic survey and the budget vis-a-vis the foreign investors and the rating agencies, how they are likely to look at the fiscal deficit and we as a nation extending the FPRM by a few more years now?
I think let me just take a few data points historically on what the international institutions have been saying, doing, and projecting. If you look at, let's say, 2010, when IMF was predicting that there will be a global growth of less than 2%, about 1.9% global growth, the global growth actually came out to 5.1%. Look at it, the prediction was about 5.5%. We grew to 10.5%, double of what was predicted. Consistently, what we see is international institutions giving a very pessimistic outlook. In fact, 2009, the outlook was a minus 1.3% global growth, and it was actually a minus 0.6% global growth or global degrowth that happened in 2009. If you look at the 1996 Asian financial crisis, which was a very severe crisis on this side of the world, economies like Muhammad was asked not to peg their currency to dollar or any other currency for that matter, and leave it as a free float currency. Malaysia was the first one to actually go ahead and peg their currency. First ones who actually came out of the financial crisis very, very early and very quickly because of this step that was taken. So I think the question mark that actually arises is on some of these rating agencies, because clearly India is on an extremely strong wicket. We can all see the growth that's happening around us. We can feel that this decade will be the decade of growth. We see all the rationalization in the economic structure, in the financial structure, in the industrial structures that have happened. We've got a terrific demographic profile right now, and if only we can bring their skills up more than what they are right now, we'll be in a faster growth path. Just unthinkable that we are just barely an investment grade rating, and that too with a negative outlook, which means that we can actually go to a junk rating. That clearly does not make sense, and it is not aligned to realities of India, which as you rightly said, is the 5th largest economy. Very quickly we see it powering into becoming the 4th largest economy. There is just no way that the credit ratings that India has got makes any sense as of now.
Interesting. So India should not worry too much about the ratings which are going to come, and most likely they will continue to be positive because the budget focuses on long-term perspective. And when I talk about long-term perspective, yeah, Jajit, go ahead.
Sorry, just want to clear that we do need to worry about the rating going down because it increases the cost of funds, it impacts FPIs and so on. So we need to be worried about it, and I think we need to make sure that these rating agencies have the right kind of mechanisms to rate India. But as I said, I think over a period of time, if they continue in this kind of a rating, there will be serious question marks raised. But as of now, India does stand to lose because of the negative rating.
Okay, interesting. So keeping in the long-term perspective, it looks positive. And when we talk about the long-term, I think one good thing on the tax rates, Riaz, what the government has done is by not touching the tax rates, either moving them upwards or downwards as per the popular demand, a status quo has been maintained. So two benefits out of that. One, the tax outgo, either from the businesses or individuals, remains the same. And second, it sends a very bold policy announcement to the investors, domestic as well as foreign investors, that India is aiming for a low rate tax regime and certainty on the policy making. Riaz, what's your take on the direct taxes side on that?
No, thanks, Vikas. I think it's right on the spot that in the general keeping of boosting up the economy, etc. A great thing that this budget has been able to achieve is that it has not gone to the normal ways of increasing taxes to raise the resources for the expenditure which has been committed. So I think that stability factor has been a very, very important thing, and that message is really a positive for industry. In addition to that, what it is also doing is there is also trying to continue the path for rationalization of tax laws, resolution of disputes. And I think some of the steps which have been taken towards that resolution of disputes are really positive. They go on to just push forth the theme of stability even more. So I think a couple of things that come to mind immediately is firstly the Faceless income tax appellate tribunal scheme that has come in. So we had the Faceless assessments and Faceless appeals. Now we're going to have the Faceless tribunal. Good step, bold step. It'll increase transparency. I think it is a step in the right direction. But at the same time, the success of that will depend upon the ability of all the stakeholders to adapt. So while on one hand, it may lead to a cleaner environment, for want of a better word, I think whether all the stakeholders, assessees, the revenue department, etc., will be able to adapt well, that will determine how far it will be successful. There's also a second one where there's a dispute resolution committee which is being set up. Of course, that again is the first step towards trying to get a mediation process into the assessment, the settlement of disputes. At present, it will be applicable to only incomes of, disputes of less than 50 lakhs, but I think it's a step in the right direction. It's going to increase over a period of time. So these aspects definitely lend to the added stability. Of course, there have been other incentive-based amendments which we can come across, discuss them later as we go along. But I think these dispute resolution initiatives are definitely going along with the theme of the budget at large.
So I think, Riaz, what you're saying is that from tax assessments to Vivad Se Vishwas on one extreme, we are moving somewhere in between, where on a regular basis, the government is trying that taxpayers and tax administrations should come across the table, discuss the disputes, and resolve it, just like we have in few other countries like US and others. I think this is a move in the right direction.
Absolutely. I think it's really going to add confidence.
Absolutely. Absolutely. And I think right now the limit is 50 lakhs, but gradually over a period of time, we will see changes. And maybe we will sooner rather than later, we will see that most of the tax disputes can be taken to a particular forum consisting of independent panel members, including the revenue official, where the disputes can be discussed and negotiated as well in terms of arriving at a consensus because of the different judicial precedents at different high courts and tribunals right now. So Gopal, GST is not part of the budget, but every time GST has an important role in the budget speech in terms of directionally how we are going. It's been few years now. Of course, we can debate how the reform has been introduced. Of course, there was a lot of pain initially, but to give credit where it is due, government and bureaucracy came forward, heard the concerns of the industry, and very ably made the amendments. I think we were ourselves struggling as consultants to keep track of the various changes which were happening. Hats off to the industry which has been complying. What's your take, Gopal, where we stand on GST and how do you see it going forward now?
Yeah, I think we should build on GST. I think it's been a very large rollout that has happened, and it's been pretty efficient when you compare it with what has happened to the developed economies. It did take quite a bit of time for some of these economies to adjust to the rates. I think the number of rates are also getting now lower. In the current budget, what I heard what I heard was that they are going to look at the inverted structures which still exist in pockets. And I think that needs to be corrected, especially in a seamless system like the GST that's there today. And what's been good, of course, has been that the news that has come out is the Gst Collections for January have been kind of a record. I think it was 1.3 lakh crores or so, if my memory serves me. A lot of data today. So I think that's a good thing. But of course, there are people who says, no, that's because of the pent-up demand. Well, it's good if that's a pent-up demand that's coming in. I prefer to look at the positive side of things and believe that things can only get better. And I think the mechanism is also actually getting better. It's become more efficient. The transparency is also coming in, which is also pushing compliance into it. So I would say that we would feel the effect of GST as we move forward. And the worry that we had at the time of GST rollout was the huge inflationary effect it will have, possibly have not happened, and that has also been deftly managed. So this is my view on GST. I don't think they've made any big, unless I've missed it out, there have not been any big bang announcements. But of course, on the import side, they have mentioned about reduction in steel duties, which has got nothing to do with GST. But I hope that will help industry. We as an industry are struggling with significantly high steel prices. Believe me, and it is not really elastic as we think it is. So we hope that the reduction in duty for steel would actually soften steel prices. I think there have also been a couple of announcements on export promotion, which also we're looking forward to some detail, but it's not directly attributable to our commercial vehicle industry. But I think anything that actually brings up the capability of domestic industry is good. But on your question on GST, I think I didn't see any, unless Jagdeep or Jaijit or Riaz had anything to say. Unless I missed out something, no big bang announcements have been made. But I think the system is working well, and January collections kind of epitomizes that things could get better.
So definitely the collections are going up. 1 lakh crore plus for the last 3 months gives a lot of hope and optimism both for the industry and the government that we are on the right track. Krishan, there are some changes in the fine print in the GST. Can you elaborate on the same?
Sure. I think, Vikas, some positives which came out of this budget from a GST standpoint, while GST is a subject matter of debate which the GST Council undertakes, but hats off to the government and the industry, how they worked together in the last 3 years to overcome these challenges. And there has been a lot of positive outcome of this whole exercise, the way it has happened. And it has been welcome. And because it has always been a majority decision from the GST Council, the states have always agreed to that. So I think that's the spirit in which GST is functioned and supported well by the industry. While there has been administrative burden which has been casted because of change in deadlines, extension of timelines, change in compliance requirements, formats, etc. But I think industry is mature enough to overcome those, and that's how they have looked at it. Some of the key things which come out, and one of the significant one being from this budget, there is a proposal that the annual reconciliation statement, which is the GSTR 9C, as we call it, the GST audit, which is an annual exercise for most assessees, and started from assessees which had aggregate turnover pan India above 2 crores, which comprised of a large number of assessees. They have been proposed that that requirement will be done away with. So this was a requirement which was to be a certification of your financials to the returns, and the reconciliation had to be verified by an independent accountant and professional. This requirement was basically casted upon for the reason that, one, GST was based upon self-assessment. So whatever you were declaring as part of your filing of returns was ultimately accepted unless there was an inquiry or an investigation which was conducted by the GST department. Now, the only checks which GST authorities or the government had was an independent check by say a chartered accountant who could certify the financial statements to the filing which had been done. And we are all aware of the manner in which the tax evasion and the fake invoice rackets have been busted. But at the same time, this was only checked on the basis of which the information could be relied upon because of a professional looking at it independently. Now, this requirement, to our surprise, has been done away with. I think the reason of that is, which is what is coming in the eyes of the government, is that it is not giving any additional revenue per se to the government, but only increasing the administrative burden on both the GST department to verify it, and on the other side, on the assessees and the professionals to actually look at the books on a dated basis. And each time the deadline has gone ahead, and we've seen the number of times the extension have been given, the ultimate outcome has been that the exercise has been done professionally, and that's the reason why it can be relied upon. But on the other side, we've seen that the GST department has also become very stringent in terms of raising inquiries, and GST department audits have started happening to clients. So the clients have been, companies have been wondering that whether we should go for an audit which has already been done by an independent accountant for the same period. Now the GST department is also coming to us and asking for information.
So it will be self-certification, right? It will
yes,
be self-certification.
This is the annual certification, which basically only reconciles your financial turnover, which you've been reported for the purpose of your GST filings, with the GST returns which you filed through the year. So these two things have to be aligned, and certification has to be done that the turnover declared is aligned with the GST filing which you've done. That means you've paid the correct tax and you claim the right credits. So this requirement being done away with, I think also one proposal is that the annual return, which is also an annual consolidated filing of all the returns for the financial year, there is a proposal that this may be a requirement of reconciliation which will be done on a self-certification basis, which will be merged into the annual return. Now we'll need to see, once we look at the notification which will be issued in this regard, as to how will be the coverage be, whether it will be a duplication of the same reconciliation, or there'll be a small statement or a summary which will be filed by the assessee themselves. But this independent audit has been done away with, which probably would provide a relief to the industry per se. But as we see the manner in which the departments are going, behind and checking all the verification of the data which has been filed, there is a chance that all department audits will now focus on a regular exercise, which has been going to be replacing this audit which has been done professionally.
So I think this is a big change which has come in the fine print. And also there was some mention about the input tax credits. What exactly is the change over there, Kishan?
So input tax credit per se, there has been a, because if you remember from the time GST was introduced, there were 3 returns which had to be filed: GSTR 1, 2, and 3. While GST 1 was the supply return, the 2 and 3 was basically the matching of the return to the purchaser's data, which is the GSTR 2, and ultimately the summary filing which have happened as a net payment or as a net liability, which would have been declared under GSTR 3. So 2 and 3 were never implemented because of the infrastructure which could not be implemented at the time. So there was a summary return of GSTR 3B, which was allowed to be filed by the SSC, and that was deemed to be the valid return. Now, when the automatic filing, automatic matching of credit and taxes did not probably happen that way, the government built the infrastructure now with the invoicing coming in and the automatic data, going from the vendor's supply return to the purchase procurement, returns which are internal GSTR 2A of the buyer. There was a restriction which was coming out because people were claiming returns, all the credits provisionally. Now, with this change, what the government has made very clear, and that was the direction in which they were moving, that no credit will be given unless the data and the procurement and the supply will match automatically. If that means if your vendor compliance is not proper, you are losing out money.
So I see Gopal smiling, being on a panel where consultants are saying that the compliances are going down, right, Gopal? It's good news, definitely.
You read my thoughts. Okay.
Yeah, absolutely. I saw the smile on your face here. So Riyaz, I think India's rising stature, both as a economic power as well as the soft power that we are, has its downside as well. Any unilateral action we take results into some international outburst or some reaction. The point over here is on equalization levy. India introduced it in 2 phases, and recently the US Trade Regulation Authority had a quite critical reaction to that, and the report mentioned that it is arbitrary, being targeted at the US companies, and there is a demand to come without more clarity or at least postpone it, but the government has decided to continue with it. But there is some clarity the government has provided, which was more like a lacuna. Can you share your thoughts on that?
Sure. In fact, after the US report spoke about it critically, the government also came up with a response on why it was a fair.
Yeah, it said all is well.
All is well, absolutely. Yeah. So now there had been a lot of areas where there were doubts on the equalization levy, and in fact we were expecting clarifications to come about. And now some clarifications have come, some positive, some not so positive. So primarily there was firstly, there was a lacuna, which was obviously a mistake, which spoke about the exemption from taxation of that income, which was effective from 1st April 21, whereas the equalization levy was with effect from 1st April 20. So there was a year in which the exemption would not be available and equalization levy would be still applicable, but that has been clarified. So now at least that correction has been made. Another area which which was gray was whether some of the income would classify as fees for technical services or royalty, and which would therefore, and what would classify as equalization levy. And there were doubts that in the lack of clarity, there could be situations where both would be levied. So now that clarification has come in, but the clarification comes in that first you determine whether it is royalty or technical service fees. And if it is not royalty or technical service fees, then only would equalization levy come into the picture. So obviously the tax collection under royalties and technical service fees would be higher than what equalization levy would be. So that's the direction which has been determined by the government.
I think still FAQ is desired. That will put to rest many of the questions which people have, because otherwise there are a lot of interpretational challenges which could lead to unnecessary disputes in litigation. So I think FAQ is still required on this subject.
Though as consultants, as you rightly put, we would be happy that lack of clarity is there. It helps us in our business. But no, to be on a serious note, I think FAQs would be required to make sure that these issues are clarified.
Absolutely,
now,
because yeah.
Sorry. One area on equalization levy which is come in through this budget in the fine print is actually, it could be quite damaging. So now it is clarified that whenever there is an underlying transaction, the equalization levy will be paid on the gross amount. In other words, what happens is that if you have got a seller and you've got Amazon, say, as a platform, both Amazon and the supplier would both be paying on the full value of the goods. And therefore, there will be a duplication of equalization levy to that extent. So that clarification was being sought that whether the aggregator would be required to pay only on the aggregator's part of the income, but as it turns out now, it will be levied on the gross amount by both parties. So that's good.
Good clarification. And Jajit, before I come to you and ask for the 6 pillars of this budget and where the money will come from to fund all the expenditure, Riaz, let me stick to the direct taxes. There's a clarification on depreciation on goodwill, which could have impact on the M&A transactions. What's your thought on that?
Oh, that is, in fact, a very significant announcement which never came into the speech, but it is there in the fine print. And I think that is going to have a significant impact. So, so far, the Supreme Court had, determined that goodwill is an asset on which depreciation would be allowed. And that is how a lot of M&A transactions were being structured. But today, with the proposals, what is mentioned is that goodwill will not be a depreciable asset, and which means that whether the goodwill is purchased or whether it is computed, acquired, in all aspects, goodwill will not form part of the depreciation or eligible asset for depreciation. And that will have a very significant impact on all M&A transaction structures as we see them now.
So devil is in the details. Goodwill is an important amendment which could have its own impact. I think M&A transactions need to be carefully reevaluated and reviewed vis-a-vis this particular amendment. Jajit, first question: What's your thought on the 6 pillars? Healthcare we expected. What about the others this time?
Sure. Now, before I answer your question, I only want to point out that even for the entities I was managing, we are tripped on between GST, TDS, RCM, Google Tax. Between all of this, we had tripped till we got Grant Thornton on board to do the due diligence, and we could detect all of that. So it was quite complex, and I wish in this budget. So that'll always be a wish from the industry side.
Sure.
Having said that, coming to your question, we were expecting that that the budget will cover these, but the way it has been structured out and very clearly laid out, I think that's quite appreciable. So there is a very structured way of laying out the budget rather than a whole bunch of random points in. And if you look at health and well-being, that was the first point that you mentioned. The budget talks about a Atmanirbhar Swasth Bharat with a outlay of 64,000 crores over 6 years. In fact, there's a whole bunch of very holistic
focus. Yeah, expenditure has been doubled in healthcare, right?
Absolutely. It's been doubled. And again, as I said, we should have more. And even in the last budget, as I was quoting from Major Batra of the Kargil War, that Dil Mange more. More is required. And obviously, we're a large country. We are resource constrained. But having said that, it's highly appreciable. Steps are being taken, concrete steps are being taken, and the budgets are being doubled on areas where it needs to be doubled. But also the way it has been, worded, there is intent to focus on reduction of single plastic use, of reduction of air pollution, segregation of waste, which is under the Atmanirbhar Swasth Bharat, which essentially means that we are just not talking about health as putting in medicine, but as a holistic health in terms of complete well-being of people. Similarly, physical and financial capital and infrastructure. There's a significant focus on it. And even though, as Gopal mentioned, the 20,000 crore recapitalization banks is a small drop, but at least it's happening. There is a focus. There's a signal that the government is aware of these issues and they will be taking steps to fix that. Similarly, inclusive development for aspirational India is one more step, and significant budgetary allocation has been done to make sure that we have proper human capital. In fact, reinvigorating human capital is the fourth pillar. And I've been talking about it for last couple of days that, when people are talking about infrastructure, the human capital and funding the new education policy is a very critical aspect. And if we don't have the human capital ready, we will not have the growth that we're expecting to have in this decade. I strongly, for one, believe that this decade will be the decade for India, and we will finally be able to realize the potential, because for decades we have been called as the economy which has the potential, but we have never realized that potential. I think now is the time that there are no roadblocks insofar to say, and we should be able to realize that potential if we have the human capital in place. And therefore, putting human capital as one of the pillars is extremely important. And not just that, if we are not able to have a foothold into high-tech industry, and we're not in the cutting edge of technology, again, we'll start losing out in future. And therefore, the fifth pillar was innovation and R&D, and the government has done well in focusing on that. And finally, which has always been an election slogan for this government, which is minimum government and maximum governance, has been very well laid out in this budget. And I think that's how the pillars have been built up. But, along with it, the other question that you're asking is, how will all of this be funded, and where will the money come in from, right? And deficit financing is clearly not sufficient. And therefore, serious non-tax revenue sources also need to be tapped. Where does the government get that money from? And therefore, the budget has come out with a proposal of a very, very aggressive asset monetization. And this has come out after a long, dilly-dallying, or I would say, dilly-dallying wouldn't be the right word, but playing around with the asset monetization, starting with roads. And 2016 onwards, the government has been putting in the policies for road asset monetization, and 2018 is when they actually went ahead and implemented that. So the capability is there, the skills is there. Now they have very aggressively extended it to power lines, gas pipelines, railway assets, including the dedicated freight corridors, and of course the roadways itself, which brings out a very, very neat model where if you're able to execute the asset monetization, again, we have to see whether the government is actually able to scale up and do the asset monetization that was talked about in this budget. But if they're able to do that, then the government needs to simply keep chugging around and coming out with more and more infrastructure. And since the government does it, the risks are significantly lowered, and the risks are lowered because you don't have issues like if the project gets delayed, you get caught up in unviable projects because the interest cost of debt keeps piling up, and so on and so forth, or 80% of the land is acquired, 10% is not acquired. All those issues are taken care of by the government. once the risk is lowered.
Jajit, what you are saying is that India is actually waiting for its Margaret Thatcher movement, right?
Absolutely.
But if history is any evident, barring few years, we have not met our disinvestment target. Okay. So what gives us so much hope that so much of fiscal deficit we will be able to fund through this single thing of disinvestment stroke privatization? In fact, I would like to compliment the finance minister and the government that this time they use the word privatization, not just disinvestment. So I think this is a big mindset shift and a bold policy announcement. We are calling it a privatization, okay, not just a disinvestment or some other norm. So what gives us so much confidence in terms of these targets being met? For example, even for the current fiscal, the target was 210,000 crores, whereas till date it was 15-20,000 crores, while more will come over the next 2 months or so. But what gives you so much confidence that it can actually happen now?
So because the model is slightly different, I'll still be skeptical if it's only about privatization because because the pushback that comes in our ecosystem, we still don't have an ecosystem that is aligned to what is really needed by the economy, which is privatization at this stage. But the difference is this: the difference is it's asset monetization of linear assets, of road assets, pipeline assets, power assets, all linear assets, which are not really corporatized in that sense. And it's a model which is a little different from the Thatcher model. The Thatcher model was talking about privatizing existing infrastructure.
Right.
What I could sense from the budget is it's a model where the government will continuously keep churning out infrastructure and keep monetizing it.
Okay.
And the value add will be significantly more because of the risk profile being lower when the government gets involved. And the moment they transfer it to the private sector, the value add is significantly higher. But if the private sector has to do the same job, the cost will be higher because of the risk involved in it. And therefore, if you look at the budget itself, there's a sharp increase in capital expenditure to 5.454 lakh from the previous year's 4.39 lakh crore. And there are many more economic corridors being planned, a huge amount of infrastructure for West Bengal, Tamil Nadu, and so on and so forth, all the election states.
Okay.
And we believe that can be funded because of the asset monetization route that the government is taking up.
So what you are saying is it is doable, achievable, but there is some skepticism based on the past trends.
That's right.
Right. So but it is doable. It is doable. Now we saw status quo on most of the tax rates, corporate tax rates, individual tax rate. But Krishan, there is something in the fine print which FM also mentioned, which is agriculture cess. What exactly is it and what impact it is likely to have?
So yes, as you rightly mentioned, there has been no tinkering with the rates, and even from the GST side, and I was also, hearing Dr. Jayjeet. One thing which I also, industry was expecting was that there will be some roadmap which will be announced towards the rationalization of the GST rates, which has been a long pending demand of the industry, that at least the clubbing of the rate should happen now. 12% and 18% was what was thought of at that.
But Krishan, you need the blessing of states also for that.
Absolutely. There always will be an upward and a downward trend, which will has to be matched. And looking at the current fiscal deficit and the revenue pressure, probably that would have been something which obviously would have not been touched upon. But at least some roadmap towards that would have been a positive step towards the thought process which the government is having towards that. On the same side, if you look at the custom side, the rate changes which have happened on custom duties are on two steps. One, to encourage the Atmanirbhar vision and the domestic manufacturing and boost to the MSMEs, which means that more you manufacture in India, the better stocks you get. So whatever you import directly as finished goods should be minimal. So that is something which has been the vision of this government, and they have been working towards that. So in line with that, there has been upward duty changes which have happened on a sector front in chemicals, which are essential chemicals, plastics, some electronics, auto parts, etc. But most of these changes are also directed towards equating them to give a level playing field to the domestic manufacturers one side, and also ensuring that there is no inverted duty structure. On the other side, the duty cuts which have happened are primarily to aid the import of essential raw materials, and that's what the finance minister mentioned, that the essential raw materials which still cannot be indigenously sourced should be available as an import, and that's something which can be used in the domestic manufacturing of your final product. For those duty cuts may have been the intention of the government, but at the same time, it could be also inverted duty structure. The Cess which you talked about is the Agricultural Infrastructure and Development Cess. This is a cess which has now been proposed to be levied as a duty of customs as well as a duty of excise. So as we all know that the excise is still applicable on certain products, which is petroleum products, petrol and diesel specifically in this case, where excise duties and VAT is continuing under the current regime, and they have not been clubbed under the GST regime. On these items, and specifically on certain items which are crude palm oil, gold, silver, and certain other items, there are about 25, 26 number of items on which this cess is proposed to be levied. Now this cess is the intention of the government is to put away some amount of amount from the kitty of excise and customs duty, take it away and put it as a specific cess which is to be spent on the agricultural infrastructure development and development of certain other infrastructure. Now, whenever there is a cess or a surcharge of any such sort is introduced, it goes against the spirit of the indirect tax or the GST. Because when the GST was introduced, most of the cesses were abolished and got clubbed under the GST rates. Now, anything which gets added to the cost of production or cost of procurement becomes ultimately a cost to the consumer, which will get passed on. Now, government has assured while making this statement, and also when we're reading the notifications which have come, that the corresponding duties rates have been reduced to equal effect to impose this cess, which means that if you are paying this cess as a specific levy, which has to be directed towards a specific spending of the government, the portion of this has been taken out from the duty cuts which have happened. Now, it seems that is the intention, and I hope that ultimately there is no cost addition to the industry on account of this cess. But also what would have been helpful was that these cesses should have a shelf life. There should also be a timeline to which this cess should be levied and should be ultimately when the objective is achieved, it should be removed. So that is something which has not happened as of now.
Sure. And question on the customs duty side, while a lot of rationalization has been done, do you think customs duty require a complete overhaul?
Yes, to the extent that there has been there has been a continuous effort in terms of also to promote Make in India, to boost domestic manufacturing. A lot of duty, inverted duty structure, all of these areas have been worked on, and tirelessly government is working towards that. The overhauling is basically required to the extent that there should not be any unnecessary exemption which should be available to a specific sector, because as you've seen with the commitments towards WTO and the way the export promotion benefits also are being given, there has been a check on that, and there should not be a double benefit which should come out, and that is how the global alignment will be done. To achieve that effect, objective, it probably is in the line of that, as well as the second objective, which was the primary one, is to align it to encourage domestic manufacturing.
So I think the whole policy regime towards in context of the customs duties moving towards a stage where the encouragement is to manufacture in India rather than importing the finished products. Raw material is fine. I think that is what you're saying. Okay.
That's right.
Riaz, whenever I hear about gift in the budget, I think some gift is coming towards the industry or us, but actually it is talking about more investments and more structuring in the gift or the IFSI. So any thoughts on that?
So there have been some changes which have come in. There have been some clarifications to further incentivize the IFSC experiment. So in terms of, certain specified investment funds, if the fund manager is based in the IFSC, then the fund will still be eligible for the IFSC concessions. So that's a clarification to kind of say that would mean that the fund manager is based outside the country. Here, while this announcement has been made, the conditions have not been specified. So we don't really know what conditions will be levied. And once those conditions are known, we can find out how easy it would be to actually comply with those conditions or not. They've also said that the investment banking units of foreign banks will also be eligible for investment conditions. So I think the IFSC eligibility criteria is being broadened to include more and more activities there, and that could help us in making that a bigger success. So yes, some changes have come in, but some the conditions and clarifications need to be seen to that they need to be announced. In fact, for us to establish how worthwhile or what will be the kind of impact that we have.
Right, right. I think the whole underlying objective of IFSC is to provide an alternative to New York, London, and Dubai. In spite of all the constraints, I think things are moving in the right direction. Despite certain challenges, over a period of time, many clarifications have come in. More tax benefits have been provided, like there is something about REITs and InvITs also this time. Jajit, even during the pandemic, one good thing or one great thing which happened in India was in terms of the gross capital formation. Gross capital formation, even during the worst of the times during pandemic, was at about 29%. Whereas if we look at the peak rates in the past few years, it was 37%. To my mind, it gives the biggest hope in terms of the capital formation and the future productivity. In the economic survey, there was a clear mention that now with the question which I raised to Gopal as well, that private sector needs to come up. There's a limit up to which government will keep pumping money. And that's what exactly is happening across the globe, whether it is US, UK, Brazil, or for that matter, India. A lot of fiscal policy support, a lot of monetary policy support has been provided. And there was a term used by the economic principal advisor that forbearance should come in over a period of time. Okay. Unlike what we are seeing in many parts of the world, where large part of the debt is trading at below zero interest rates. Okay. A lot of liquidity is pumping in the stock market, but India, the advice has been forbearance, and this should get curtailed over a period of time. Otherwise, a bad loan problem in the bank, etc., will come up. So my question to you is, keeping in view that gross capital formation has been decent and it continues, billions of dollars of FDI comes in, more than $50 billion, $23 billion of FI money also came in the last year. Indian diaspora is also sending a lot of money. 2019, it was $80 billion plus. In terms of the investments flowing in, okay, vis-a-vis the government's own fiscal and monetary policy support, when do you think is the right time for government to start tapering it and interest rates going up in India?
So, because I mean, for the last 3 decades, from 91 onwards, what we observed is just when the industry is recovering and it's going up, somehow the government decides that that's a time that they should suddenly increase taxation, interest rates, and so on, and it becomes a massive dampener. So tapering is the right word, and how we taper is the key word. Instead of drastically, one fine day taking out forbearance and increasing the interest rates, I think it's important that in this decade, and not next year, not next to next year, but at least for next 5-6 years, we have a little supportive regime which helps unleash the animal spirits, and that's a term which became popular again in the 90s. But it's still important to have those animal spirits in place for a longish time. And if you compare it with China, which really started growing again in the late 90s and early part of 2000, they did not curtail the easy money that was there. They did not curtail some of the flexibilities and the incentives that was given by the government. In fact, much of it carries on even now. And therefore, that's a template that exists, that has worked well. I would be in favor of actually, having this period extended. Again, not being profligate, not being, unnecessarily giving too much in that sense, but maintain a certain level which should be tapered down very gently over a period of time. Mm-hmm. That would be my view. And if you look at the budget itself, it's trying to push for certain, India becoming a leader in certain spaces. And I think that is important. For example, creating the textile parks, or the thrust on space, the incentives on R&D, which then puts us back into leadership in industrial technologies. And we were a leader in industrial technologies in the 18th century. We were a leader in textile and had a significant share of the global trade because of superior technology in textile. I think those are the things that needs to be done in the ground. The detail is important, and calls on forbearance and incentives needs to be slowly taken off. And I strongly believe that it should be there for at least 4 to 5 years.
So, right, Jayjit, all steps in the right direction, but requires a lot of patience and perseverance. Gopal, one question to you. You provided us the industry perspective. As an individual, what's your take on the budget?
I think the finance minister could not have done better under the current circumstances. You've got a huge fiscal deficit in the current year. You had a pandemic of, which has been across the globe. Revenue streams have come off, right? And then expenditure had to go in a totally unbudgeted manner into tackling COVID. There is still a mass of, especially the lower end of the pyramid, who are still not earning sufficiently to create the grassroots level demand. And so, given this backdrop, I don't think the finance minister could have done better than this. And I would only say one thing. I think the whole thing is going to depend on execution.
Right.
Ultimately, I would say that the business plan has been prepared well. Now we need to execute that, and there are challenges still because I believe that COVID would go out soon. Like I told you, I'm optimistic by nature, but I think the thing is going to be to ensure that there is hard-nosed execution, because we can have this high fiscal deficit for next year, maybe even year after that. But after that, we need to get in, the revenues into the country, from the taxation system, from all other means, to ensure that the spend is sufficiently generated from what we are earning. Otherwise, it can mean a little bit of challenge in the medium term. But good budget, I would say, everything depends on execution. Because my apologies, I said 5 o'clock. I have a board meeting. I would excuse myself with my esteemed panel members and all the other participants about this. Thank you very much for the opportunity. Pleasure, and I look forward to interacting with you.
Thank you, Gopal, for sparing time. Gopal's final words, very optimistic. Execution is the key. And as strategic guru tells us that 30% is strategy, 70% is execution. Riyaz, I think a lot of revenue neutral measures in terms of ease of doing business as well, in terms of various things. Can you quickly share your thoughts on that?
Sure. Before the ease of doing business, there's just one point I would like to raise. While we've spoken about a lot of things on the corporate side, as you know, that pre-budget there were a lot of expectations on the individual taxation. Right. So I thought that we could briefly refer to that. While no real reliefs have been given, in the fine print, when you see, there has been a bit of negative news there. That's on the Provident Fund. So I think while interest on Provident Fund has always been exempt, right, with the change that has been proposed, any interest on contributions over 250,000 rupees will now be subject to tax, and that interest that could have an impact on a large number of.
Right. So gradually, if we look at it, we have been moving from exempt regime, triple E regime, to EET, exempt tax regime. That's I think over the last few years, including this year's budget, government has taken some steps towards that. So overall, what we are hearing is that it's a big, bold budget, right, Jayjit? Optimism, lot of hope, long-term growth strategy. I think the execution will be the key. Thank you very much, all the panel members, and thank you everyone for joining us today. I hope you enjoyed the panel discussion. The budget brings in a lot of optimism and hope, and let's hope that India marches ahead with rightful execution, rightful asset monetization, and becomes a 5 trillion economy soon, and that benefits each one of us and helps us uplift the poorest of the poor to join the mainstream in the economy. Thank you very much.
Thank you.
Thank you.